Welcome to TP Talks, PwC's Global Transfer Pricing podcast series. Today, I have the pleasure of introducing David Ernick as the guest host for TP Talks. David is a tax principal with PwC's Washington National Tax Services practice, where he specializes in transfer pricing planning and documentation, cost sharing, IP transfers, audit defense, competent authority proceedings, APAs, and tax valuation services. David is a great addition to the podcast, and we're thrilled to have him. David, I'm going to hand it over to you.
Okay. Thank you for that introduction, Dana. And to all of our listeners, welcome again to TP Talks. This is our next episode where we continue the discussion on the OECD G20 Pillar 2 model rules. In our first episode on Pillar 2 back in February, we provided an overview of the rules, addressing some of the complexities and, importantly, the role of transfer pricing in the Pillar 2 regime. We discussed how the model rules place the arm's length principle at the core of the Pillar 2 calculations and how we were waiting for the commentary to the model rules. For the second episode in our series covering Pillar 2, we'll discuss the commentary, which was published in March, and how it has slightly reinterpreted the role of transfer pricing in Pillar 2. Also, we've got some important recent developments coming out of Europe that Giorgia will explain for us, including the UK stakeholders consultation and the ECOFIN progress regarding implementation of Pillar 2 within the EU. And with that, let me introduce our speakers. First, I've got Giorgia Maffini from PwC UK. Giorgia is a PhD economist and special advisor on tax policy and transfer pricing at PwC. Before joining us, she was the deputy head of tax policy and statistics division at the OECD Center for Tax Policy and Administration. And before joining the OECD, Giorgia was a senior economist at a little place called Oxford University in their Center for Business Taxation. And we've had a chess theme to our podcast so far. The first one was really about the opening. And now today, I think we're in the middle game. In keeping with that theme, if I had to compare Giorgia to a piece on the chessboard, I would certainly choose the queen. So as we all know, the queen is the most powerful piece in the game of chess and also the most mobile, able to move in any number of squares vertically, horizontally, or diagonally, combining the power of the rook and the bishop. That sounds like Giorgia. And I'm also delighted today to be joined by Kartikeya Singh, who's a transfer pricing principal with me in PwC's US national tax practice. He's also a PhD economist, and his practice covers all the typical facets of transfer pricing. And in keeping with our theme, if I had to compare Kartikeya to a chess player, I would of course choose Magnus Carlsen, the Norwegian chess grandmaster who's the reigning 5-time world chess champion. Magnus is known for his attacking style as a teenage prodigy, his subsequent development into a universal player, along with his positional mastery and endgame prowess. That describes Kartikeya also. And as I said, of course, I'm David Ernick, transfer pricing principal with Kartikeya in our national practice in the US. If I were a chess piece, I would probably be a mere pawn, which, as we all know, is the most numerous piece on the board, but also the weakest, unfortunately. Although it's important to remember, it's also been said that you should never underestimate the pawn, because if you get the pawn to the other side of the board, it can become a queen. So I've got that going for me. So with that out of the way, let's start the substantive discussion portion of our podcast today. Giorgia, let me turn to you. In the last few days, there have been a few developments in Europe. Could I ask you to take us through them and explain why these developments are important for the implementation of Pillar 2?
Hi, David. Thank you very much. And thank you for the very generous introduction. So as it's often the case, there are a lot of developments in Europe, especially around, these big changes of the corporate income tax system. And maybe I should start from what has happened in the UK, because the UK turns out to be the first country that has announced when the Pillar 2 rules, in particular the GLOBE rules, will be in place for multinationals. So on the 14th of June 2022, obviously, the UK Financial Secretary to the Treasury announced that the UK legislation on Pillar 2, so again, GLOBE, so the income inclusion rule, primarily will apply to accounting periods beginning on or after the 31st of December 2023, meaning that the income inclusion rule will apply for most to financial years 2024. Okay, so we have about, let's say, a bit less than 18 months until the rules come into force in the UK. One very important element of this announcement is that the Financial Secretary to the Treasury also said that the UK government plans to publish draft legislation on GLOBE in summer 2022, so this summer. And this is very important because the publication of draft legislation triggers the first reporting requirement. So for multinationals that have a material impact of Pillar 2 on their financials, these multinationals will have to disclose this impact if material, again, for a balance sheet and financial statements published after the publication of draft legislation, and not only if they are headquartered in the UK, but just if they have operations in the UK. So I think this announcement from the UK side is very important from the practical perspective for many of our clients. But then if we move from the UK to the continent, on the 17th of June, the ECOFIN wasn't able to arrive at a unanimous support for the Pillar 2 directive. So we still have some uncertainty about when the rules will enter into force in Europe. So for the EU 27 countries, it might be, so the French presidency will end on the 30th of June 2022. The Czech Republic will become president of the European Union for the next 6 months, and it remains to be seen if the Czech can, bring the Pillar 2 directive over the line, and in particular, if they can convince Hungary, which is now the only country that is not supporting the Pillar 2 directive, to support the directive. And David, maybe a couple of observations. So the directive that is being discussed at the moment, that is on the European Union table, let's say, says that the rules, in particular the income inclusion rule, will apply to financial years, again, beginning on or after the 31st of December 2023. So for most, it would be financial year 2024. So there is an alignment between what the UK has announced and what is in the European directive for the moment, really. But it remains to be seen when and if the European Union is able to pass the directive, which, let's remember, needs to be passed at unanimity. So we need all 27 member countries to agree on the directive.
Okay, thank you, Giorgia. That's very helpful. I think that discussion is important because it puts into context the potential developments in the US, particularly if other countries move forward before the US, the impact on US multinationals and the incentives for the US government to implement the Pillar 2 regime. And so the status in the US currently, just at a very high level. So if we remember originally, I think the US position was Pillar 1 and Pillar 2 sort of go together. They kind of belong together. But now we seem to be in a world where Pillar 2 is moving forward more quickly. From the US perspective, in our current tax system, I think there are two areas of focus that people have been concerned about. One would be the treatment of our GILTI rules. So we enacted our own minimum tax before everyone else, but what is the status of that under the Pillar 2 regime? And also, again, at a very general level, the treatment of the credits that we have in our tax system. But starting with the first point, so with respect to GILTI, I think there are concerns about whether or not this would be a qualified IIR regime. And I think the consensus is not under its existing form. But we've had proposals to amend the GILTI regime, both in the Build Back Better Act, which would have amended GILTI by moving it to a country-by-country calculation and increasing the rate to 15%, bringing it closer in line to some of the provisions of the Pillar 2 rules. And then also in March of this year, we also saw the Green Book proposals by the Biden administration to reform GILTI, and also proposed a qualified domestic minimum top-up tax, in addition to a UTPR, under tax profits rule, similar to the OECD proposals. So we've got those concerns out there about the treatment of GILTI. Even if those amendments are made, would it be considered to qualify as an IR regime? Or if not, does that then qualify as a CFC regime? So we've got questions about that, but no sort of real action right now from the US. But again, as I said, the US might be forced to take the initiative in making some changes if other countries move forward before the US has amended their rules. Those are the concerns around GILTI. And then, as I said, we've also got questions about our credit regimes. And I think we're all looking for some clarification about whether those would be good credits under the global minimum tax rules, whether the benefit of those credits would be preserved under the OECD rules. And I know Treasury has been working on that, and they've made some public statements about that. But those are important issues too, because I think the area of focus is on things like our low-income housing tax credits, renewable energy credits, new markets credits, things like that. Very important credits that we've put into our tax system to incentivize certain behavior, making sure that the US FIS still gets the benefit of those and that it's not reaped by other countries. But that's also another issue that I think people are focusing on very much in the US. But as I said, I think the issues are out there. There are various proposals to address the issues around GILTI and our credits in the US. But at this point, there's some uncertainty, especially with respect to what would be the vehicle for making those changes to our domestic tax rules and what would be the timing on that. So with that update on the status of Pillar 2 in the US, let me turn it to Kartikeya now. And if I could ask Kartikeya, so we had the commentary to the model rules published back in March, and that contains some new things in relation to the treatment of transfer pricing. Could you walk us through how that commentary has impacted Article 3.2.3, and has it changed the interpretation of the role of the arm's length principle and transfer pricing under the Pillar 2 regime?
Sure, David. And again, before I start, like Giorgia, let me start off by thanking you for your highly generous introduction. Before I answer your question, let me do a quick recap, because obviously there's so much to talk about when it comes to Pillar 2. What we are trying to talk about is, where does transfer pricing and the arm's length principle, what role does it play in the application of Pillar 2? And one of the points that we made on our last podcast was that in a minimum tax regime, which is what Pillar 2 is, that applies on a jurisdictional basis, a country-by-country basis, the income allocation standard, which is what we apply, which is the arm's length principle and the separate entity concept together with it, is instrumental in the functioning of that min tax regime, because it shapes those interjurisdictional income allocation outcomes. And so it's worth reiterating that when you look at the application of a min tax regime, your starting point as to what the income is on a country-by-country basis, that is going to be shaped by the application of the arm's length principle and transfer pricing in general. Article 3.2.3 in the model rules was a specific provision, a specific article that dealt with aspects of how related party transactions are priced and how they're reported in the financial accounts. And in particular, the purpose of Article 3.2.3 seemed to be in the model rules at least, it seemed to be one about accuracy, or one about ensuring that the financial accounts, which were the basis or the starting point of your globe income calculations, were not distorted on account of related party transactions between group entities in different jurisdictions. And for that reason, the language of Article 3.2.3 called for an adjustment when either of two possibilities or two possible situations existed. One where a related party transaction between two entities in two different jurisdictions was either not reported in the same amount, or it was reported in an amount that was not found to be consistent with the arm's length principle. And if either of these two conditions were met, then the model rules called for an adjustment to the amount of that intercompany transaction, so that the adjusted amount was then compliant with the arm's length principle and reported in the same amount in the financial accounts of both entities. And this made perfect sense. It made eminence because, again, like I said, the starting point of the globe income calculation was the financial accounting income of each entity in each jurisdiction. And if that financial accounting income was distorted or not found to be accurate because it was influenced and affected by a related party transaction that was not compliant with the arm's length principle and not reported in the same amount, it made perfect sense to make an adjustment to bring it back in line and to ensure that there was no distortion in the subsequent computation of the globe income, etc. Now, while sound in principle, the article did raise some questions among observers like Giorgia and myself, and I'm sure other transfer pricing practitioners. And those questions had a lot to do with a lot of very common fact patterns that you encounter when you're applying transfer pricing, and in particular when you're applying one-sided methods, one-sided situations like unilateral safe harbors and advanced pricing agreements, etc., where you could have a situation where you had an amount, where you had a related party transaction that possibly was reported in the same amount, but was reported in an amount that availed of a one-sided safe harbor or one-sided treatment that was afforded by one jurisdiction in a way that did not create an issue or a risk from a transfer pricing standpoint in the other jurisdiction, and yet may not have been viewed as being compliant or conforming to a universal definition of the arm's length principle. And so the question that arose was, well, in the strict reading of the model rules article, would that lead to situations where an adjustment would be made, where potentially that adjustment would not be accepted by every single taxing authority viewing it, and then thereby lead us down the road of uncertainty and potentially controversy as well? So what we have now is the commentary that you mentioned and a number of examples accompanying that commentary. And the first thing that struck me when I was reading the commentary is that relative to the plain reading of the model rules, the commentary seems to have shifted the purpose of Article 3.2.3 and shifted the purpose in a way where it seemed to be more related to accuracy and ensuring that the measure of income was not distorted on account of transfer pricing and related party transactions. The commentary and the examples seem to have shifted it to a situation where an adjustment is warranted and needed to avoid situations of double taxation or double non-taxation. So it's not so much about accuracy and no distortion per se, but one where it is about ensuring that there is no double taxation or double non-taxation. And what do I mean by that? Well, what I mean by that is spelled out in the commentary, and what it says is that an adjustment is going to be needed when there is a difference between how a related party transaction is reported in your financial accounts and how it is reported in the computation of the taxable income of one or more constituent entities that are party to that related party transaction. And one can elaborate on this, elaborate this with a simple example. So think of a very simple situation where you have an entity in country A and a related party in country B that are party to a related party transaction. Let's say it's the provision of a service where the entity in country A receives a payment from the entity in country B. And let's say that payment is priced at $100. That price is consistent with the arm's length principle, and that is also the amount that's reported in the financial accounts of both entities. However, let's say that because of a unilateral APA in country A, the actual amount that country A recognizes in its taxable for its taxable income is actually only $50. So there's a difference between the true, let's say, the universal definition of an arm's length principle compliant price and what is agreed upon between the taxing authority in country A and the taxpayer, so that what is recognized for tax purposes is only $50, so an amount lower than what is recognized in the counterparty jurisdiction. Well, what the commentary and the examples say is then this will require an adjustment, and the adjustment will start in country A and the calculation of the globe income for country A, such that it is the amount that's recognized for tax purposes that is going to feed into the globe income calculation, in this case, $50 rather than the $100, which means that the globe income in country A would be lower than what would be suggested by the financial accounts. But this then leads to a ripple effect and means that there would be a corresponding adjustment in country B, which had paid $100, but now would only be allowed to recognize a $50 payment for purposes of the globe income calculation. And correspondingly, the globe income for that particular entity in country B would be higher by that amount. And so this is the gist of how the adjustment would work under Article 3.2.3 as explained in the commentary and as in the examples. There is also a caveat to all of this that which is a bit inconsistent with the general principle that has been articulated in the commentary, which is that if country A was a so-called undertaxed jurisdiction, and what I mean by that is that, again, loosely speaking, if all else equal, country A would be subject to a top-up tax, then actually no adjustment would be needed either in country A or in country B. And the reason for that is that if, in fact, an adjustment would be made in the manner that I described, the top-up tax in country A would, in fact, be lower and possibly completely eliminated. And so in order to avoid that, no adjustment would be needed, which suggests to me that the commentary and the examples that are there in the commentary seem to prioritize the output more than one universal principle, which is about ensuring parity between the tax treatment and the financial accounts, which is the basis for the globe income calculation. So I know I've said a lot, but suffice it to say that the commentary seems to have moved the purpose or changed the purpose of Article 3.2.3a as articulated in the model rules. It seems to have clarified the situations and the circumstances under which an adjustment would be needed under the application of the model rules. But again, it doesn't really eliminate complexity or uncertainty around the implementation of those rules.
Thank you, Kartikeya, for those important points around the changes from the commentary with respect to the purpose. So let me turn again back to you, Giorgia, and again, coming back to the UK, following up on your earlier discussion. So I know there's been an extensive stakeholder consultation within the UK. Have they given any further clarifications on how transfer pricing and transfer pricing adjustments should be working?
A little bit, David. So they clarified a little bit what is in the commentary. The commentary and these public stakeholders meetings move away from the initial spirit or the initial language of the model rules with respect to Article 3.2.3. And in particular, so in these stakeholders meetings, we had a group of Treasury officials and officials from the tax authorities that were taking us through many of the technical details of Pillar 2. And with respect to Article 3.2.3, they gave us some simple rules. And the first rule is, as Kartikeya was saying, so we will adjust the globe income for transfer pricing only when there is a difference between the account and what you have in your tax return, in your local tax return, for transfer pricing purposes. If there is no difference, no adjustment. Then there is a second set of cases where, for example, you have a difference between your local tax return and your accounts because you have entered into a multilateral agreement with a set of tax authorities. In that case, we are told at those stakeholders meetings that you would need to adjust your globe income according to what you have agreed with the various tax authorities multilaterally. And in that case, of course, all the entities involved in the transaction will have to use the same figure, clearly with different signs, probably. And then there is a third set of cases, and this talks a lot to the examples that Kartikeya was describing. And these are when you have a unilateral adjustment in your tax return because, for example, as Kartikeya said, you have an APA or you had a unilateral audit. In this case, we are told the rule would be that you adjust your globe income according to what you have in your tax return locally, only if that adjustment happens in a high tax jurisdiction. So in a jurisdiction where the effective tax rate is above the 15%. Whilst if that adjustment is made in a undertaxed jurisdiction, so a jurisdiction with the effective tax rate below the 15%, you should not make any adjustments because you can work out, as Kartikeya has explained, that in that case you would have either double taxation or double non-taxation. So this is what we are told in the UK, but it seems to me that this is really not the end of the story. We will need more guidance, and hence we will have to see what the implementation framework tells us about 3.2.3. And it might well be that we are moving even further away from the model rules with that implementation framework with respect to the treatment of transfer pricing adjustment. And one of the reasons is that with Kartikeya, we have applied these, indications of the UK Treasury and tax authorities to transfer pricing adjustments in the past. And we have seen that in some cases, for those transfer pricing adjustments in the past, applying the rules we are told to apply, we identified situations where there is double taxation. And this is down mainly to the fact that if you have topped up in the past in a low tax jurisdiction, you will not be repaid back what that top up that you have paid in the past and that you probably shouldn't have paid. So it seems to me that even with the indications we have been given here in the UK, they have helped a lot, but we haven't solved all the issues around transfer pricing adjustment under Pillar 2.
Thank you, Giorgia. Let me turn back to you, Kartikeya, and could I ask if you could walk us through now the implications for transfer pricing if there are instances of double taxation in the Pillar 2 system?
Sure, David. And Giorgia has actually already touched upon that. I will start by making an observation, and this is going to might come as a shocker to us transfer pricing practitioners who spend so much of our time trying to resolve and trying to avoid situations of double taxation. But the first observation that I want to make is that double taxation, in a very fundamental sense, if it means the taxation of the same income twice or more than once, is actually an essential feature of Pillar 2. And what I mean by that is that double taxation is, if Pillar Two's overarching objective is to ensure minimum taxation, then double taxation is the mechanism through which it tries to achieve that objective. So when you see what I mean by that is that you have taxation at source by, let's say, a jurisdiction, which in my example of country A and country B, where country A receives a services payment and A, as a source country, imposes a tax on that jurisdiction. As soon as you have a situation where another jurisdiction, let's say an IRR jurisdiction or a UTPR jurisdiction, has the ability and a claim on a top-up tax over and above the tax that is already claimed by that source jurisdiction, you have double taxation in a literal sense, in a sense that is in keeping with the definition, and I mean economic double taxation. It is not dissimilar to a situation where you have corporate profits being taxed twice, once at the level of the corporation via the corporate income tax, and then once again at the level of the shareholder. So in that sense, not to belabor the point, double taxation is an intrinsic feature of this mid-tax regime. But the question then becomes, can the rules and importantly the interaction among the different components of the rule lead to situations of double or multiple taxation that appear at odds with the overarching principle? And this is where some of the examples and situations that Giorgia touched upon become particularly relevant, because then, unfortunately, the answer to that question becomes yes, it does seem quite possible, particularly given the very complex environment that we as transfer pricing practitioners observe on a very regular basis in the controversy environment, an environment where we expect the Article 3.2.3 to work. So Giorgia already touched upon a potential for double taxation that goes beyond what the stated intent or the principal intent of these rules appear to be, that come from the interaction of 3.2.3 and section 4.6.1. And in fact, we've actually talked about that at some length in our prior podcast. But that specter of, I'll call it unintended double taxation, also comes up in the very simplistic example that I described earlier through the application of 3.2.3 as intended by the commentary. And here there's another point that I would make, that this is a theme that is common across the Pillar 2 rules, the model rules and the commentary, which is not limited to 3.2.3, that when you look at the different provisions interacting and overlaying with each other, you actually find a lot of unintended and very surprising implications that perhaps were not as evident to the drafters of these rules. And through those interactions, you can have a situation where, let's say, in my earlier example, where jurisdiction B, if you recall, you will have to make an adjustment under 3.2.3, where jurisdiction B will not get the full deduction of $100, even though that's what's used and under which its local tax liability is calculated. But for GLOBE purposes, the only deduction it will get for GLOBE income calculations will be the $50, because that's the income that was recognized on the counterparty side. If that adjustment then interacts with some other permanent or temporary book tax differences, which are not that rare, you could certainly have a situation where you would now have an ETR for GLOBE purposes in jurisdiction B that's below the 15%, and therefore you would have a top-up tax in jurisdiction B, in my example. Even though from a structural standpoint and from a headline rate standpoint, jurisdiction B may well be well above the min-tax rate. So again, not to get into too many specifics and very, very granular examples, but suffice it to say again that the interaction of these rules and the interaction of 3.2.3 with a lot of the other elements and other provisions that are there in the model rules can create the potential for double taxation, where that double taxation is actually at odds with the overarching principle of Pillar 2 model rules.
Thank you, Kartikeya. Those are all important points. And as we wrap up our discussion and as we get prepared to sign off, I think maybe one of the overarching takeaways in keeping with the theme from our earlier podcast was that transfer pricing is not an afterthought. Transfer pricing and the rules for allocation of income across jurisdictions will remain at the core of Pillar 2. And I think that's clear from even after we've seen the changes from the commentary. So we need to keep that in mind going forward, the importance of transfer pricing, having that in order under the Pillar 2 rules as they play out and become implemented shortly. And we will discuss that on the upcoming podcast 2 more with respect to the implications of the transfer pricing rules on Pillar 2. And in closing, let me again thank Giorgia and Kartikeya for their very insightful comments today. Thank you again for listening and have a great day.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.